Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is the starting lineup for your 3 in 10 podcast for October 24th, 2025, recording at 3:20 p.m. Eastern Daylight Time from a beautiful autumnal Hartford, Connecticut. Number 1, we're digging and researching on private credit. Our motto as researchers is to trust but verify. Number 2, 3M third quarter earnings. If I could only listen to one earnings call, this would be it, because 3M is a diversified multinational that spends a lot of its revenues on R&D, high percentage of revenues on R&D. Number 3, inflation data. Finally, we get the CPI and core CPI data this week. We also got University of Michigan inflation expectations and some PMIs to top it off. So back to number 1, digging in on private credit. All week and last week, we've been doing our channel checks with our managers, talking to strategists, talking to economists, and our network. We've been reviewing our public market indicators, which are credit spreads, CDS markets, credit default swaps, BDC equities, and publicly traded alternative managers like Ares, Apollo, KKR, Blackstone. We've been digging into bank loan loss provisions. We see there doesn't concern us at all. In fact, it's quite positive. They're not taking big loan loss provisions. But the U.S. economy is slowing, and the labor market is softening. The tide is going out a bit. Of course, that's why the Fed is cutting. And when the tide goes out, we see who is swimming naked. And of course, we've seen that First Brands was Tricolor, New Fortress Energy, amongst others. But we see no systematic downturn in the credit cycle taking place today. Our recession watch indicators are not giving a warning signal. The Fed is going to cut rates next week, and they're going to cut rates again on December 12th. We are comfortable. We find ourselves comfortable with our credit investments, especially in opportunistic private credit. There are pockets of weakness. There are more pockets of weakness than broad-based weakness. And the common thread that's running through these weak credits is the low-end consumer. Where companies have exposure to the low-end consumer, they're more at risk. Only one of our managers had any exposure to the highly publicized credit blow-ups. And that brings us comfort. Number 2, 3M earnings. 3M is highly geared toward global trade, which has been under pressure for years. But the company reported a very solid third quarter, reporting $2.19, up 10% year over year versus a street estimate of $2.07. Operating margins were up 170 basis points year over year, very impressive. The company guided to up over 200 basis points for 2025, and the stock ripped over 8% on the quarterly result. That's a big move for a big company. So R&D spend has been rising. New product innovation is rising for 3M. They've introduced 250 new products in 2025. Interestingly, they said global economic trends are soft. Only electronics were up. They were up mid-single digits, but the consumer was flat, and the auto aftermarket was down. There we are with autos again. Same problem with First Brands and Tricolor. Low-end consumer. China. First time I've heard this in a long time. China led growth at 3M, up high single digits. Very strong in adhesives, films, electronics, bonding solutions. So China has been held down by real estate for a long time, but the stimulus measures that have been in place for going on 2 years now are starting to lead to higher growth. Europe has returned to growth. First time in many quarters, they said, up 3% year over year, with growth across all segments of 3M's business in Europe. Maybe this is a reason that non-US equities are outperforming. Things are actually getting better on the margin in the rest of the world. The US housing market is still weak, just decidedly weak. And that's reflected in poor roofing granule sales at 3M. So that's why I love 3M. They touch everything. There are plenty of pluses and minuses in the macro environment. The US is growing 1 to 2%. Global is growing about 3%, and that's reflected in 3M's earnings. But the company's doing a much better job of managing their business and taking out costs and converting earnings into cash flow. And I think that's why the stock was up so much. Global bellwether tells us that things are okay. Now, number 3, inflation data. The headline CPI printed 0.3% for September. That was just below the street estimates of 0.4%. Core CPI printed plus 0.2%. That was one tick below the 0.3% the street was estimating. Both are running, interestingly, both running 3% year over year. This has long been a thesis of ours that inflation is solidifying around 3%. And I think these data are bullish for risk assets. Markets are starved for data, and they finally got some inflation data, and they were supportive for risk. This keeps the Fed on the cutting path, not only for the 29th of October next week, but also for the 10th of December. There's going to be more liquidity for markets to thrive on in the critical fourth quarter. Now, the University of Michigan 5 to 10-year inflation survey ticked up a bit from 3.7 in August to 3.9% in September. I don't think this one really matters. It's a modest increase. The Fed has, because it's convenient for them, they've been ignoring the inflation survey from the University of Michigan, and they're focused on other things. But once again, U.S. inflation has settled in at 3%, not the Fed's 2% target. Consumers understand this, but the Fed's going to cut anyway. And the Fed is going to cut because they can't afford to be tarred with a recession on their watch. The president has set them up for that, and they know they've got to maintain their independence. So a very easy release valve for Fed independence is to cut rates. And as we've seen, the rhetoric from the administration has died down significantly now that they're firmly in a rate-cutting cycle. So I'll touch on the PMIs quickly here. S&P Global Flash PMIs for October were surprisingly robust. All 3 beat estimates and priors from the month before. Services were especially strong at 55.2. Remember, anything above 50 indicates expansion. Anything under 50 indicates contraction. So service is strong. Manufacturing well above 50. The composite beat. It looks to us like recession is still a ways off basis these leading PMIs. This is a similar message we're getting from our recession watch indicators. Risk assets appear to be set up for a good run into year end. The bullish seasonal just started on October 22nd. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.